There is a number sitting inside a government PDF that most financial journalists did not read carefully enough. The release identifier is USDL 260723, published by the US Bureau of Labor Statistics on the morning of May 13, 2026, and the number it contains is 1.4. That is the monthly percentage increase in the Producer Price Index for final demand in April, seasonally adjusted. The Dow Jones consensus forecast was 0.5%. The actual print came in nearly 3 times that estimate. This was the largest single-month advance in producer prices since March 2022, a period most Americans associate with the beginning of a very uncomfortable chapter in their financial lives. The 12-month unadjusted figure now stands at 6.0%, the biggest year-over-year surge since December 2022. Let that sit for a moment. We are not at the beginning of an inflation story. We are somewhere deep inside one, and the models that were supposed to tell us where we were have been shown once again to be broken. In my years of tracking macroeconomic data and analyzing the signal underneath the noise that mainstream financial media tends to produce, I have rarely encountered a data release so violently at odds with consensus expectations that also received so little sustained analytical attention. The financial press ran headlines, markets lurched, treasury yields moved to their highest levels since mid-2025, and then the conversation shifted to whatever came next. But the data did not go away. USDL 260723 is a forensic document, and if you read it as such, it maps 8 distinct structural fractures in the global financial system. Each one individually would be worth serious attention. Taken together, they explain something that the standard toolkit of financial analysis is struggling to process. Why silver, an industrial metal that Wall Street analysts were projecting would average somewhere in the $39 range for 2026, is currently trading above $87 per ounce, more than doubling those consensus targets in real market conditions. That is not a rounding error. That is not a temporary geopolitical premium that will fade when diplomacy resumes. That is a system mismatch so large it demands a structural explanation, and that is precisely what we are going to provide today. We will move through the inflation shock, then to the institutional transformation happening at the Federal Reserve, then to the geopolitical trigger in the Strait of Hormuz, and finally to the inventory dynamics in the silver market itself that are creating conditions no paper market model was designed to handle. And we will end with the strongest available case for why everything we're about to discuss could be wrong, because intellectual honesty is not a weakness in this business, it is the only sustainable edge. Let us begin with the fracture that opened in plain sight. The April PPI data is not simply a hot number. It is a signal about where price pressure is originating and how broad-based it has become. Nearly 60% of the April monthly advance came from a 1.2% jump in final demand services, the largest services side increase since March 2022. Final demand goods moved up 2.0%, driven in large part by a 7.8% surge in energy prices, with gasoline alone rising 15.6%. More than 3/4 of the goods side gain traces directly to energy. This matters because energy price shocks are typically the most visible and politically legible form of inflation. They show up at the pump, they register emotionally with voters, they generate headlines. But the services component is where the real story is. 2/3 of the services advance was driven by a 2.7% jump in trade services margins, which is the measure of what wholesalers and retailers are collecting above cost. When trade margins expand at that rate, it tells you that businesses at the distribution layer of the economy believe they can pass costs forward, and that their customers are absorbing those costs rather than pushing back. That is a confident signal from the private sector about the stickiness of inflationary psychology. As someone who has spent considerable time analyzing how information moves through financial systems and how algorithmic models respond to structured data inputs, I can tell you that the signal most likely to be ignored by automated trading systems is the one that does not fit cleanly into the regime they were calibrated for. The models running most institutional trading desks were trained on post-2009 disinflation, and more recently on a soft landing scenario in which the Federal Reserve had successfully contained inflation without triggering a recession. April's PPI print was not a soft landing data point. It was a structural deviation from that framework, and the systems built around that framework are now producing outputs that do not match observed reality. The second fracture involves the institution that was designed to manage exactly this kind of situation. The U.S. Senate voted on May 13, 2026, to confirm Kevin Warsh as the next chair of the Federal Reserve, succeeding Jerome Powell in the most divisive confirmation vote for a Fed chair in modern history. The 54-45 margin, with only a single Democratic senator crossing party lines, tells you something important about the political environment in which monetary policy will now be made. Warsh takes the helm at a moment of maximum institutional complexity. He inherits a Federal Reserve that is simultaneously facing the strongest inflationary impulse since the early 1980s, a president who has made no secret of his preference for lower interest rates, and a committee of voting members who are, based on publicly available statements, genuinely divided about the appropriate policy response to energy-driven stagflation risk. What makes the Warsh appointment structurally significant for precious metals is not his specific policy preferences, though those matter. It is the uncertainty premium that a leadership transition creates in the mind of anyone pricing long-duration assets. When the chairman of the Federal Reserve changes, market participants must update their probability distributions across every future interest rate decision. The previous distribution, calibrated to Powell's known risk preferences and communication style, is now obsolete. The new distribution has wider uncertainty bands by definition. Uncertainty at the Federal Reserve is a tailwind for assets that carry no counterparty risk. Gold and silver carry no counterparty risk. In my own tracking of how the 10-year Treasury yield interacts with non-yielding hard assets, the current price action in silver is particularly striking. The 10-year yield has been running in the range of 4.45 to 4.48% over the past several days, hitting new highs for the year following the PPI release. Classical financial theory tells you that a non-yielding asset like silver should face headwinds in this environment because the opportunity cost of holding it rises as yields climb. Silver is currently disregarding this relationship in a way that no textbook I have studied would have predicted. The third fracture is energy, and it is the one that is most directly visible in everyday life. The Strait of Hormuz, the waterway through which approximately 20% of the world's oil and liquefied natural gas flowed before late February 2026, has been effectively closed to normal commercial shipping since the outbreak of the US-Iran war. Brent crude has been trading in the range of $105 to $108 per barrel, after touching $126 per barrel at the April peak, and WTI has been running above $102. The U.S. Energy Information Administration's May short-term energy outlook projects Brent will average around $106 per barrel through May and June, with prices gradually declining only as the strait slowly reopens and production begins to recover. The Saudi Aramco CEO has warned publicly that even if the strait opens immediately, the oil market will take until 2027 to fully normalize. Over 600 tankers are reportedly stranded inside the Persian Gulf, with another 240 waiting on the other side of the strait. The International Maritime Organization has described the humanitarian situation for the approximately 20,000 stranded seafarers as without precedent in the modern era. The energy shock is doing something important to the inflation picture beyond simply raising gasoline prices. When energy costs rise this sharply and this persistently, they propagate through every supply chain in the global economy simultaneously. The same PPI release that showed a 7.8% surge in energy goods also showed elevated pressure in transportation, in industrial chemicals, in jet fuel. These are inputs to inputs. They affect the cost of making things, the cost of moving things, and the cost of storing things. When David Russell, global head of market strategy at TradeStation, said in response to the April PPI data that inflation is sticky and accelerating and that the core reading confirms a deeper structural trend, especially in services, he was describing exactly this propagation dynamic. The Hormuz crisis is aggravating an existing structural problem, not creating a new temporary one. The fourth fracture is geopolitical, and it involves a decision made in New Delhi. India, the world's second largest gold consumer, and a country with one of the deepest cultural relationships with precious metals on Earth, raised its import tariffs on gold and silver to 15% from 6% on May 13, 2026. The move more than doubled the previous duty structure, combining a 10% basic customs duty with a 5% agricultural infrastructure and development levy. The immediate trigger was currency defense. India's foreign exchange reserves have fallen from a record high of over $728 billion in late February to approximately $690 billion by early May, a drawdown of nearly $38.5 billion in roughly 10 weeks, driven in large part by surging import costs for crude oil and by elevated demand for gold imports that had reached an average of 83 tons per month in early 2026. I have analyzed how policy decisions in large emerging markets affect commodity flows, and what India's tariff move illustrates is a recurring structural tension in global precious metals markets. When a country with enormous physical demand for silver and gold erects price barriers, it does not eliminate that demand. It redirects it. In high-tariff environments, grey market importation becomes economically attractive because the arbitrage opportunity between legally imported metal priced above duty and internationally priced metal is large enough to generate substantial profit margins for illicit supply chains. The All India Gems and Jewellery Council warned explicitly that the duty hike would encourage smuggling, a concern grounded in historical precedent from every previous high-tariff era in India's bullion market. The net effect on global silver supply availability is therefore ambiguous in the short term, and potentially negative for official market transparency in the medium term. The fifth fracture is one that most mainstream financial commentary has not fully processed. Beijing has moved systematically to reclassify silver as a strategic material, a designation that carries significant implications for global supply chain access. China is simultaneously the world's largest industrial consumer of silver and a major producer. When China restricts the export of materials it has designated as strategic, the global fragmentation of the silver market accelerates. Regional price premiums diverge. Supply chains that previously relied on Chinese-sourced silver must find alternatives. The Shanghai Gold Exchange has been trading physical silver at significant premiums to Western paper benchmarks, with divergences that at times reach 12 to 13% above LBMA spot and COMEX futures prices. In Japan, secondary market premiums have surged dramatically. These regional divergences are not the behavior of a unified global commodity market. They are the behavior of a market that has fractured into competing regional supply islands, each trying to secure physical metal in an environment where above-ground stocks are declining. This connects directly to the sixth fracture, which is the one happening inside the COMEX warehouse system. The Silver Institute has now flagged a sixth consecutive annual deficit in the silver market for 2026, extending a structural shortfall that has been running continuously since 2021, with cumulative above-ground stock drawdowns estimated in the range of 762 million ounces over that period. COMEX registered silver, which is the metal actually available for futures contract delivery as opposed to metal stored at the exchange but not designated for delivery, has been declining. By late February 2026, registered stocks had fallen to approximately 86 million ounces before the dramatic delivery stress events of the March cycle. During that March delivery season, over 10,500 contracts stood for delivery on first notice day, representing demand for approximately 52.6 million ounces, which was equivalent to more than 60% of all registered inventory in a single trading day. That is not a normal delivery cycle outcome. The paper leverage ratio, which measures how many ounces of futures contract exposure exist for each ounce of registered deliverable metal, currently stands at approximately 6.5 times. The coverage ratio, the inverse of that measure, is running near 15%, which analysts who track COMEX stress conditions characterize as tight territory. For the great majority of the time that COMEX has been operating, the assumption embedded in the system has been that most futures contracts will settle financially rather than demanding physical delivery. The system was designed around this behavioral assumption. What the 2026 delivery data suggests is that this assumption is under stress. Large industrial users and institutional investors are increasingly demanding physical metal rather than rolling contracts forward because they need the actual silver for manufacturing processes that cannot be satisfied with a paper claim. My perspective has always been that the most important signal in any market is the one that the majority of algorithmic participants are programmed to ignore. The COMEX delivery data is exactly that signal. It does not fit neatly into a model that prices silver as a financial derivative of macroeconomic variables. It is a signal about the physical world, about manufacturing throughput, about solar panel production schedules, about the consumption needs of electronics manufacturers who need silver today and cannot wait for a futures contract to mature. When solar manufacturers, electric vehicle producers, and AI data center operators who are consuming silver for server cooling and electrical connectivity start negotiating direct off-take agreements with primary mining companies rather than relying on exchange delivery, they are expressing a loss of confidence in the paper market's ability to guarantee physical supply when they need it. That shift in behavior is not priced into a model that treats silver as a financial asset. The seventh fracture involves the mathematics of industrial demand. Silver's role in the global energy transition is not speculative, it is calculable. Each standard photovoltaic solar panel uses silver in its electrical contacts. Modern next-generation solar cell architectures require more silver per unit of power generation capacity than older designs, not less, because the efficiency gains that make them attractive come from electrical designs that rely more heavily on silver's conductivity properties. Electric vehicles use silver in their battery management systems, power electronics, and thermal regulation circuits. Solid-state battery architectures, which multiple major automotive manufacturers are pursuing for next-generation vehicles, may require substantially more silver per battery pack than current lithium-ion designs. AI data center infrastructure is consuming silver in quantities that were not modeled in demand forecasts, prepared even 2 or 3 years ago. Physical investment demand for bars and coins is projected by the Silver Institute to increase approximately 20% in 2026 to around 227 million ounces, which would represent a 3-year high. Annual silver mine production is constrained by a structural reality that price signals cannot quickly change. Approximately 70% of silver is produced as a byproduct of base metal mining. Silver is extracted alongside copper, lead, zinc, and gold. Primary silver mines that produce the metal as their principal product account for only about 30% of global supply. When silver prices rise, miners cannot simply open new silver mines in response because most silver supply depends on the economics of base metal projects that are governed by the prices of other metals. New primary silver mining projects take years to develop and come to production. The supply response to elevated silver prices is therefore structurally slow, even when the demand response is immediate. The eighth fracture is the one that I find most analytically interesting because it is the fracture that occurs when multiple systems interact simultaneously in ways that no individual model captures. Wealth is not simply about what you own. As I have often reflected when working through complex financial data sets, it is about understanding the plumbing of the system that prices what you own. The plumbing of the silver pricing system involves at least three interacting layers. The physical market, where real metal changes hands for immediate delivery at prices that reflect genuine supply-demand conditions. The paper market, where futures contracts and derivatives create multiples of exposure to that physical reality. And the policy layer, where central banks, government tariff authorities, and geopolitical actors make decisions that reshape the physical and paper market simultaneously. When all three layers are under stress at the same time, the divergence between where models say prices should be and where they actually are can become very large. The 12-month silver price performance, up approximately 173% from the same period last year according to market data from major commodity price services, is a measure of that divergence. It is not a prediction that the trajectory will continue. It is an observation that something structural has changed in the relationship between paper prices and physical reality, and that the repricing that is underway reflects market participants updating their assessments of that relationship. Now let us do something that separates serious analysis from advocacy. Let us build the strongest available case for why everything described above might be wrong or overstated. The bearish counter-argument begins with energy. If the United States and Iran reach a negotiated resolution to the Strait of Hormuz crisis, crude oil prices could fall rapidly and substantially. The EIA's own base case projects Brent dropping to an average of $89 per barrel in the fourth quarter of 2026 and $79 per barrel in 2027 as production gradually recovers. A rapid resolution scenario would compress that timeline. If energy prices fall sharply, the headline inflation impulse retreats. If headline inflation retreats, the Federal Reserve under Kevin Warsh has more room to consider rate reductions. If rate expectations shift toward cuts, the opportunity cost argument against holding non-yielding silver reasserts itself, and a significant unwinding of speculative long positions could push prices materially lower very quickly. The demand destruction argument also deserves serious consideration. At silver prices above $80, $90, or $100 per ounce, industrial users face strong incentives to accelerate research into silver substitutes and to reduce silver loadings per unit in their manufacturing processes. Solar panel manufacturers have been working on designs that use less silver per watt of capacity. Electronics manufacturers are exploring alternative materials for specific applications. Substitution does not happen overnight, but the incentive at current price levels is very large, and substitution research that was moving slowly at $25 silver moves much faster at $87 silver. The COMEX stress narrative also requires a degree of caution. The exchange has mechanisms including margin requirement adjustments, position limit enforcement, and cash settlement alternatives that have historically prevented formal default scenarios even under acute delivery pressure. The exchange survived significant stress events in the past without a breakdown in the price discovery function. While the current delivery dynamics are unusual, concluding that the paper market is on the verge of a structural failure requires evidence beyond what current data provides. The probability of such an outcome remains a matter of genuine analytical dispute. India's tariff increase is a headwind for demand, not just a currency defense measure with neutral price implications. India consumes enormous quantities of silver and gold. If the tariff reduces official import demand even partially, that removes buying support from one of the world's largest consumer markets. The tariff-induced smuggling dynamic is real, but informal demand flows do not provide the same market price support as transparent commercial demand recorded through official channels. Finally, monetary policy itself is uncertain in both directions. Kevin Warsh has stated publicly that he will use his own judgment and not take direction from the White House. He has inflation-fighting credentials and has previously argued that quantitative easing went too far in the post-financial crisis period. It is possible that his tenure at the Federal Reserve will be more hawkish in practice than the market currently expects, maintaining or raising interest rates in response to persistent inflation. A genuinely hawkish Federal Reserve in a slowing growth environment would apply real downward pressure on silver prices, particularly the portion of the current price that reflects monetary debasement concern rather than industrial supply deficit fundamentals. What does the synthesis look like when the bullish structural case and the bearish counter case are placed against each other? The honest answer is that the distribution of possible outcomes for silver over the next 12 to 24 months is unusually wide. The floor is set by industrial demand fundamentals that are structural and largely independent of the geopolitical situation. Solar energy deployment, electric vehicle adoption, AI infrastructure build-out, and conventional electronics manufacturing will continue to require silver regardless of whether the Strait of Hormuz reopens next month or next year. 6 years of cumulative supply deficits have drawn down the above-ground inventory buffer that previously cushioned the market against demand surges. Mine supply growth will be slow. These are not speculative arguments. They are accounting identities derived from production and consumption data. The upside case depends on whether the paper market continues to function under delivery pressure or whether the structural stress documented in COMEX vault data triggers a broader repricing event in which the premium for physically allocated metal becomes very large. The downside case depends on whether geopolitical resolution, policy response, and industrial substitution combine to reduce demand faster than supply deficits would predict. What makes the current moment unusual is that both the upside and the downside scenarios are plausible simultaneously, and the market price you observe today, somewhere in the $87 range with gold at approximately $4,700 and a 10-year treasury yield sitting around 4.45%, is what you get when a market cannot resolve which scenario it is living in. The 8 fractures documented here, the PPI shock, the Federal Reserve leadership transition, the Hormuz energy crisis, the Indian tariff response, Beijing's strategic material reclassification, the COMEX inventory dynamics, the industrial demand acceleration, and the simultaneous stress across all 3 layers of the pricing system do not individually dictate a specific price outcome. But they collectively describe a market that is no longer operating under the assumptions that the models pricing it were built to handle. When the models are wrong by this magnitude for this long, the appropriate response is not to assume they will soon be right again. It is to understand why they are wrong, what they are missing, and what the physical reality of the market is telling you that the paper reality has not yet fully priced. This is not an invitation to abandon caution or to position aggressively based on a single analytical framework. It is an invitation to look at the data from USDL 260723, to examine the COMEX warehouse reports, to read the Silver Institute's deficit projections, to understand what the confirmation of Kevin Warsh at 54 to 45 means for monetary policy uncertainty, and to form your own conclusions from verified, publicly available information. The signal is there. Whether it is the one you expected is a different question entirely.